What is good, everyone? So in today's video, I'll be going over exactly what liquidity is, how you can use it, and how you can match it with the strategy that I use that has made me over 6 figures in trading, and literally a step-by-step guide on how you can do it, how you can copy it, and basically become profitable yourself in trading. And now to start off, I'll quickly go over the strategy that I use, just a brief overview, and then after that, we'll be getting into a step-by-step guide on how you can copy it as well and make a lot of money in trading by doing so. So watch until the end, take some notes, and let's get into it. What is good, everyone? So this right here is what the strategy is all about, the breakout plus liquid grab strategy. So to put it into fewer words, it is basically taking advantage of a stop out or a wick out or a liquid grab, same thing, right? And then taking advantage of that momentum and volume after the liquid grab. That is literally it, okay? So we don't trade like 99% of traders, because 99% of traders are, let's put it into bearish perspective, a low, lower high, lower low, lower high, and lower low. Now, realistically, is the market going to reject here? Yes, it might reject, but it's not going to push all the way down, most likely, right? Because everyone is in the position. When everyone and retail traders make money, the market loses money. When the market makes money, everyone else loses money, okay? And obviously, there's a reason why 90% or 99% actually lose money in trading. Like 99% of retail traders lose money, aka the market wins. The market wins all the time unless you create an edge, right? That's what this strategy is all about. It is basically an edge, right? Obviously, it doesn't work without proper psychology, but that's like any other strategy. But basically, instead of taking sell positions right here, like most retail traders are doing, because let's say that 95% of retail traders are getting into positions right here. Now, is the market just gonna push down and everyone makes money? No, it's not gonna do that. It is gonna push up and then stop out everyone with their stop loss up here, and then it's gonna push down, right? That's how the market tricks everyone into hitting their stop loss and then hitting their original take profit. So the market makes money, basically. The market makes money and everyone loses money, and that is what we want to take advantage of. Now, it is like, I'll show you an example here real quick before we get into all the details of it. But look at here. Let's say that everyone was in sell positions right here. Stop loss up here, take profit down here. Looks pretty solid for a sell, right? But is the market going to shoot down? No, it's not. It is most likely going to shoot up, stop out everyone, and then it's going to shoot down, okay? So let's see here. This was a trade I took as well. Look, it stops out everyone, and then that momentum after the liquid grab is going to be absolutely crazy. It's like a rubber band. Look at this, okay? Look at this rubber band. In order for price to go up, we need to go down first. And in this example, in order for price to go down, we need to go up first, right? In order for the rubber band to shoot down, we need to do something like this, grab liquidity, stop out everyone, all the retail traders, and then boom, there's going to be a lot of volume, okay? That's how you want to see the strategy. It is basically, in this example, on the charts right now, we are pushing up at market open, and then boom, we get that big move to continue down. If it was, was vice versa, the market needs to go down first in order to go up. So it needs to grab liquidity, grab orders right here, and then push up. Boom, right? That's what the strategy is all about. We take advantage of that momentum and the volume after the liquid grab and after everyone has gotten stopped out. The first form of liquidity is in a bearish trend. There is liquidity up here above previous highs. There's liquidity up here above previous highs. There's liquidity here, here. In a consolidation phase, right? There is equal highs and equal lows. Okay, wait, this low was actually not that equal, but there's equal highs up here, equal lows down here. That's the two forms of liquidity, okay? Above or below previous highs and lows, and above or below equal highs and equal lows, okay? Basically, just from my experience, and because I know that there's equal highs up here, I know that price most likely wants to hunt this before we get that move. So I'm not going to enter here. I'm going to wait for the market to push up to that level right there, right there, and then we can take advantage of that move post liquidity grab. As I said, it's a rubber band theory, right? In order for price to go up, we need to go down first. Boom. In order for price to go down, we need to go up first. Boom, right? That's kind of how you want to see it. Then you can target these lows down here. Beautiful trade, 80% win rate. Doesn't get any more simple than that, right? That is basically it. And you can use liquidity levels as your pre-plan analysis for your anticipation of the entry. You can use it for your stop loss. You can use it for your take profit, right? In this example, I would either, as I said, stop loss is obviously above the liquidity grab. We'll get into stop losses and take profits, but take profit is either below this previous low right here because there's liquidity here. And whenever there's liquidity, the market tends to react to that or reject that, right? Or I could target, I actually, on this trade, I targeted these lows here because there's some kind of equal lows down here. As you can see, if we zoom down, yes, this did get broken in theory, but there's still a lot of orders down here. Look at this, right? That's what I targeted. And that made totally sense because look at this red line got rejected and then we shot directly up after that, right? So that's kind of how you want to see liquidity. Two types of liquidity: above or below previous highs and lows, above or below equal highs and equal lows. All right, so what is a liquidity grab slash sweep? So a liquidity grab slash liquidity sweep, it's the exact same thing, okay? Just, it's just being marketed from different gurus online to their advantage, and then they sell something. It's stupid, right? But it's the same thing, okay? A liquidity grab and liquidity sweep, it's the exact same thing. Now, what is it though? It is basically whenever price wicks out and stops everyone out, and then it's going to move, right? So it happens over and over again every single day. It happens on lower time frames as well. It happened right here. Look at this. Broke previous high and continue down, right? It's happened right here. Look, broke these lows right here, continued up. Now, this is not textbook, obviously, but it's just to, kind of get it into your head that a liquid grab is just a, break of previous highs or lows or equal highs or equal lows, right? Happens over and over again every single day, right? Look here as well. Broke these highs, liquid grab, continuation, right? Let's go to some more here. Look, broke previous highs right here, liquidity grab, continuation, because there's liquidity above or below previous highs and lows. In this case, previous highs, right? Liquidity grab, continuation, right? So this is the continuation. If we go back here, I'll probably zoom into lower time frames. You can see it even better here. Look, textbook. These three phases right here is the let's mark this red. Let's actually go to circles here. Continuation. Then we get that sideways move, consolidation. Then we get that liquidity phase, right? Liquidity. Then after the liquidity, CCL, we get that continuation again. Remember, continuation, consolidation, liquidity. Continuation, consolidation, liquidity. Repeats itself over and over again. Look, it's the same exact move as here. Continuation, consolidation, liquidity. Rubber band effect, in order for price to move down, we must move up first, right? Here, liquidity, boom, continuation, right? Continuation, consolidation, liquidity, continuation. And so this is how and where to draw your levels, liquidity levels and zones, basically, right? Where you want to anticipate and pre-plan the liquidity grab is going to happen, right? Now, if we look at this chart right here, right? Let's actually go a few bars back. So just to keep this in mind, right? In a bearish, let's actually draw a bullish trend first, right? Higher high, higher low, higher high, higher low, and higher high, right? These are significant levels price will most likely reject. But is it going to shoot up here? As I said before, probably not. It'll probably start rejecting, and then everyone gets in, right? All the research traders get in buy, stop loss down here, and then they are going to take advantage of, or try and take advantage of that move, after that rejection right there of a significant level. Is price going to do that? Most likely not. It's most likely going to shoot down, liquidate, stop out everyone, and then it's going to move, right? So as I said, you have to understand whenever you're drawing your level, this needs to be above or below previous highs and equal, or no, wait, above or below previous highs and previous lows, or above or below equal highs and equal lows, because there's liquidity there. We're anticipating that there's going to be liquidity, so you need to make it make sense. Where is the liquidity going to be, right? It's going to be above or below previous highs or lows, and above or below equal highs and equal lows, and it's going to follow the overall trend. So in this case, there's liquidity below these equal lows either, or these, lows down here, right? And then we'll get that move post liquidity grab. So, I mean, wait, why did I draw this on TradingView? But anyways, in this example right here, the overall trend is bearish. Okay, the continuation is bearish. Got it. The consolidation is right here. Price is moving sideways right here. Now, if I were in this trade, or if I was looking at this, I would draw out my levels up here, above this high and above this high, for an anticipation. I was probably going to be anticipating a move up here, and then if we start flipping bearish, we can take advantage of that move post liquidity grab. Look, then the phase 3 comes into play, the L, right? The liquidity right here. After the liquidity phase, we get that continuation phase post liquidity grab. So I would draw out my levels right here, right there, right? Now, I would most likely draw a level, like a significant level, probably up here, or yeah, like down here and up here, right? And then I would draw these red lines, which I am anticipating that there is going to be a liquidity grab, because my red lines are liquidity levels, pools, or whatever you want to say. There's also liquidity down here, right? And that's what I'm anticipating price will move up to and then reject after that. And if it does that, in this example, it also does that right there, I'll take advantage of that move post liquidity grab. We'll get into entries, etc. Right? I'll probably either target this. This is a 1-to-1, 80% win rate, super profitable, or you could target these equal lows down here. You can kind of say that this is equal lows because these are damn near close, lows right here, right? So now we know about timing, we know about volume in different sessions, in different pairs and instruments, and basically everything about it. But how do we anticipate the liquidity grab, and how do we anticipate where it's going to be at and when it's going to be at, right? So typically, as I said, on futures, typically happens at an NYC, so at 9:30. 9:30 to 10 a.m. That's typically when the liquidity grabs happen. Sometimes, rare occasions, it happen at 10:30 a.m. Eastern, but most of the time, 9:30 to 10 a.m. Eastern, right? So in this case right here, we got that liquidity grab at NYC. You can see right there on the timing below, 3:30 p.m. my time. That's 9:30 a.m. Eastern, right? And where do we anticipate it? Well, if we go back here, as I said, we anticipated to, first of all, we draw out these significant levels. So there's a significant level up here, right? And there's a significant level down here. And then there's kind of this iffy range right here. You can kind of say that there's a level here, something like that, right? There's also a level up there and a level down here, right? And then actually just leave this level in the middle. That doesn't matter. But anyways, let's mark out the liquidities levels and buy side and sell side liquidity. So this is London highs right here, right? We can mark that out. This is this is London close, like New York close highs up here. Let's see, Asia highs are here. That already got ran through right there at London open pretty much. And yeah, that's basically it. So for the overall trend is obviously bearish here. So I'm looking for a liquidity grab to the upside before we get that move to the downside, right? As I said, rubber band effect, price needs to go up before going down and vice versa, right? So I'm looking for a price to either move up here, liquidate London highs, right? And then move down, or liquidate London highs and also these New York close highs right here, right? That's basically it. And then for targets, we can look at this wick right here. This is the previous NYC lows, right? And there's also some lows down there. That's Asia lows that got liquidated at pretty much London session, and then there's London session lows right there, right? That's basically it. So buy side liquidity right there, sell side liquidity here and here. Now, as I said, because we are in an overall bearish trend, I'm looking for a liquidity grab to the upside, and then we get that move to continue down. And if we were to draw it in circles right here, this is the continuation. I think this was FOMC. No, this was just NYC. Look at this. This is just so volatile, bro. NYC is always so volatile. This is the continuation in CCL. This is the consolidation, price moving sideways. Then I'm looking for a liquidity grab up here or up here. And then after that liquidity grab, we get that continuation. So do you see how I'm pre-planning the entire move before it's even happening? And I know this is said in hindsight, obviously, but I mean, it's the same thing every single day. It happens over and over again. So it's nothing new. It's nothing special, right? But anyways, I'm expecting a liquidity grab up there, and I'm expecting once we get that liquidity grab, we'll probably flip bearish and reject it, and then we can continue down. So the wick is either going to be up here or it's going to be up here. That's kind of how I'm anticipating the liquidity grab is going to be at and when it's going to be at. So NYC opens up right now. This is actually from 9 a.m. to 9:30. So this was pre-NYC. Then NYC strikes. Let's see what happens. Boom, push up, liquidates these highs up here, this red line, and then we start flipping bearish and continue bearish, right? Now, your entry would probably be on the candle flip right there, 30-minute candle flip, stop loss above the liquidity grab. You can target these London session lows down here, or these previous NYC lows down here, and these previous daily lows if we go to the daily time frame as well. All right, so a thumb of rule here is that we use the higher time frames for direction and bias. So that means the weekly, daily, 4-hour and 1-hour for direction and bias, and looking at the higher time frame overall trend, right? Then we use the 30-minute, 15, 5, and 1 minute to identify the best possible entries and exits and risk management during the trade. But I'll get into this as well, don't worry. So right here, we've got a 1-hour time frame price action, 3 1-hour candles. That's obviously 6 30-minute candles, 12 15-minute candles, and 36 5-minute candles. I'll go over this, don't worry. But anyways, here's basically just 3 bearish candles. It is pretty straightforward, right? A bearish candle, another bearish candle, but this is kind of not that strong, so it's most likely moving sideways on the lower time frame. Then there's a liquidity grab breaking previous high right here, then the continuation. And if we go to the 30-minute, it's the exact same thing. Two 30-minute candles right here. That's the 1 hour, close down here, exact same price action. As I said, all of these time frames are the exact same play, just different time frames, right? But anyways, if you're not familiar with the CCL, there's only 3 phases in trading, okay? The market can only be in one of these 3 phases, and then it repeats itself. It is a repeatable process, and when something is repeatable, you can take advantage of it and make a shit ton of money with it. Now, as I said, there's only 3 phases to the market. There's the continuation. I'll draw it out right here, continuation. Then there is the consolidation. Then there is the liquidity, so CCL, and then it repeats itself. CCL, 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 right? Just repeats itself basically. So CCL, continuation, consolidation, liquidity. And then after the liquidity, we get the continuation again, right? That's just the 3 phases. Like the market can only be in this no matter which time frame, no matter which session, no matter which pair, no matter which instrument, everything is CCL, right? Now, the first C is obviously the main push, the overall higher time frame. Then the second C, consolidation, is whenever price is moving sideways, generating buy side and sell side liquidity, then we get that liquidity grab, breaking, most likely following the higher time frame trend. So in this case, breaking buy side liquidity right here, grabbing buy side liquidity, then we get that continuation post liquidity grab. Now, if you're trading ICT, you may be familiar with this because he calls it distribution, accumulation, manipulation, then distribution, but I just simplified way more than that. It's the exact same thing, okay? I'm not here to copy anything, and he didn't copy it. Like it's not his thing. Like, it's not his whatever, right? That's just how the market moves. Everyone should know this. And by knowing this, by knowing that it's repeatable, you can make a lot of money and become profitable. Now, as I said, 30-minute time frame, we get that first initial push right here. Then price starts retrace with this bullish candle right here. So this is basically moving sideways. Whenever price is moving sideways, as I said, it is generating buy side up here and sell side down here because there are resting stop losses. Stop losses equals liquidity. Liquidity equals money. What does price want to do? What does market want to do? It wants to hunt the money above or below previous highs and lows, or equal highs and equal lows, right? So it pushes up at market open, typically happens at market open or pre-market open, liquidates buy side liquidity, and then we get that move. Now, this is the 30-minute time frame, and this is the 1 hour time frame. Look at this. Broke previous 1 hour high right here, right? Broke the two previous 1 hour highs right here. Exact same price action. Now, if we zoom down to the 15-minute, you'd have to understand that these candles and this candle right here is literally just a consolidation, aka accumulation, or like a sideways moving thing, right? It's just a consolidation phase. Whenever price is moving sideways, it's generating buy side and sell side liquidity. Sell side liquidity down here, buy side liquidity. Liquidity equals stop losses equals money, right? Remember that. Now, at market open, this is not one candle because this 30-minute candle is obviously one candle, but on the 15, a wick on the high time frame is just a candle closure on the lower time frame. So a wick on the 30-minute time frame is 2 candles on the 15-minute time frames. Funny enough, right? But on the 15, it's not just a wick. It's not just this wick. It is 2 candles. A bullish candle with a rejection here, and then a bearish candle after that closing down here, aka closing down here. Now, if we zoom down to the 5-minute, right, this is where we want to get our entries. Now, if we go to the 5-minute, as I said, it's the exact same price action, all of these time frames. This is basically the push, consolidation, right here, liquidity, and then push again. So CCL, right? I can even draw it out here to explain further. C, right? Then the next C, consolidation, and then we get that liquidity, right? On the 5-minute, it is also just closures because at the higher time frames, it's wicks, but on the lower time frames, it's closures. And after that liquidity, we repeat itself. So continuation again, continuation, consolidation, liquidity, continuation, consolidation, liquidity. That's how you want to take advantage of it, right? So above, you have to understand that there's 2 forms of liquidity as well. There's liquidity above or below previous highs and lows, and there's liquidity above or below equal highs and equal lows. In this case, on the 1 hour time frame, it is above a previous high up here. There's buy side liquidity up here. But on the 30-minute time frames, it's equal highs, right? On the 15-minute time frame, it's also equal highs. Look at all these highs. It's at the exact same level right there, equal highs. On the 5-minute time frame, there's also equal highs here. Then price at market open pushes up, liquidates that, manipulates, stop hunt, whatever you want to call it, and then we get that move to continue down. And you may ask, why does price want to manipulate or liquidate early sellers, right? Obviously, because everyone basically got in right here, stop loss up here, take profit down here, because this looks like a break and retest, right? A break, oh wait, that was my mistake, break, retrace to this level, rejection, everyone gets in sells right here, the market traps everyone, everyone has their stops up here, aka that's where the most liquidity is. Liquidity equals stop losses equal money. Is price going to shoot down here? Most likely not. It'll most likely shoot up first, liquidate everyone, and then shoot down, right? Happens on every single time frame, every single pair, in every single session. Now, it's most likely going to happen in a more volatile session, obviously, because the more volume there is, the more liquidity there is, right? That obviously makes sense. But if we go to the 15-minute, everyone most likely has their positions right there, stop loss up here, and take profit down here. Is the market going to shoot down? No, it's going to shoot up first, manipulate them, and then it's going to shoot down. And that is what we want to take advantage of. So instead of entering right here and getting stopped out, we enter post liquidity grab, and then we take advantage of that continuation post liquidity, right? I hope that makes sense. So instead of entering here on the lower time frames, this is the exact same entry on 30-minute, 15-minute right here, and then the 5-minute right here, right? Instead of entering here with the stops up here, then you get liquidated. We take advantage of that move post liquidity grab. So we enter right there with the stops above the liquidity grab, because if the stops were to get broken, the trade is no longer valid. The stops are placed at a logical levels, because if price wants to break that, it's most likely not continuing down anyways. And then we take profit at a significant level, or at equal lows or equal highs, or below or above previous highs and previous lows. That is how you want to take advantage of top-down analysis. So this is how to combine market structure with liquidity grabs, okay? So this is the theoretical way of market structure and how it prints, right? This is the theoretical way. Remember that, theoretical, okay? It's not going to move like this, but this is how it moves on paper, right? If you were to draw it or write it down, right? It's going to be more choppy, more realistic, and more all over the place when you see it in real time. But this is the theoretical way of market structure, and you should know this by now as well. It is a clear in a bullish trend, high, higher, low, higher, high, higher, low, and higher, high, right? In a bearish trend, it is a low, lower high, lower low, lower high, and lower low, right? That's just how price moves, right? Theoretically. It's also how it moves, but it moves more choppy. It moves more like it's probably going to shoot down a bit, then it's going to shoot up, and then it's going to shoot down, and then do something like this, then a mini liquidity grab within a liquidity grab, and then something like that. But the idea is still there, right? It is a low, lower high, lower low, lower high. This is where everyone gets trapped in, right? All the retail traders see this rejection of this significant level right here. Let's make it purple, right? Significant level, rejection right here. Everyone gets in sells, right? If everyone gets in sells with these stops up here, is the market going to shoot directly down? No, it's most likely not. The idea is still there because they're taking advantage of this lower high, right, in a bearish trend. So the idea is still there, but it's missing liquidity grabs, right? That's where liquidity grabs come into play. So because there's stop losses up here, because there's two forms of liquidity, above or below previous highs and previous lows, and equal highs and equal lows. In this case, above previous highs, so there's liquidity up there, aka stop losses, aka money, right? Price is most likely not just going to shoot down and everyone makes money and the market loses money. No, it's going to shoot up, so everyone loses money and the market makes money, right? And then it's going to move in that continuation post liquidity grab. So you can also draw the CCL right here. This is the C. This is the another C consolidation, and then this is the liquidity right here, right there. And this is the continuation post liquidity, right? I know there's a lot of drawings right here, but that's basically market structure combined with liquidity, but there is layers to this, okay? So if we were to go on a bullish example, let's actually make this a bit mid-screen, yeah, something like that. Price is most likely not just going to reject this area and shoot directly up. No, it is realistically not. Let's say that there's a significant level right there, and let's say that price starts to reject right here, right? Now, if price was this easy to read, and if price did this every single day, everyone would be a millionaire and everyone would make money, because this is how 99% of traders are taught, and this is how basic market structure is. Everyone knows this, right? A breakout of a significant level, in this case, this is the significant level, a retracement to that significant level, a rejection of that significant level, everyone gets in buys here, stop loss here, take profit up here, everyone wins, everyone makes money, everyone becomes a millionaire, everyone becomes profitable. But that's not the reality of it, right? 99% of traders never become profitable. 99% of traders never make it because they're trading this way. And now this is not how price is going to move here. Price is not going to move like this, okay? It is going to reject here. And then everyone thinks that, okay, well, it's a break, retracement, rejection, right? It is a high, higher low, and I'm anticipating this high up here, right? So everyone gets in buy position, stop loss down here, stop loss equals liquidity, liquidity equals money. Is price going to shoot up and everyone makes money? All the institutions, all the retail traders makes money? No, it's most likely not going to do that. It's most likely going to push down, liquidate sell side liquidity in a bullish trend, buy side liquidity in a bearish trend, and then it's going to shoot up post liquidity grab. Okay, so the continuation post liquidity grab. So this becomes the continuation, the hard push. This becomes the consolidation where price moving sideways, and this becomes the liquidity grab. After the liquidity grab, we get that continuation again, CCL, right? But I could also go over it by looking at the higher highs and higher lows, right? So let's draw this. So this is a high, higher low, right? Higher high, higher low. This is where everyone thinks that this higher low is going to be at. Well, is it going to do that? No, it's most likely going to trap out everyone. So first of all, start rejecting. So it's going to trap everyone into taking buy positions right there. And then it's going to most likely align with a market open, right? If that's London open, New York open, or NYC open, it is most likely going to align with the market open, right? So at market open, we shoot directly down, liquidate this. All these early buyers that got into sell, buy positions right there with these stops down here, they got ran through, manipulated, stop hunted, liquidated, and then we get that move and the continuation post liquidity grab, right? And in a bullish trend, we would like to see sell side get liquidated first, right? So sell side is liquidity below previous lows or at equal lows, and buy side liquidity is liquidity above previous highs or at equal highs. Okay, so in a bullish trend, it makes sense to liquidate sell side liquidity first because we are in a bullish trend. Remember that. So everyone that had their buys up here, they got ran through right there, and then we still move in that bullish direction, right? So do you see this, right? So it's in bullish trend, and most likely we will see a liquidity grab to the downside in the bullish trend, trapping out early buyers, right? Stopping them out, and then moving following that overall daily or higher time frame direction, right? And now this was not the higher low. Yes, there's a high, higher low started to reject, so everyone got in. But this now becomes the higher low on the higher time frame. If that makes sense, right? So this higher low failed because there was no liquidity grabs. Now that right there is the full course. And if you want access to free educational stuff that can actually help your trading, just check the link in the description and join my free Discord. And if you want one-on-one mentoring by me, check the first link in the description as well. Other than that, if you liked the video, please leave a like, comment, and subscribe, and I'll see y'all in the next video.